Okay. First of all, Happy New Year to everybody, and I wish you all a very prosperous and happy and healthy 2015. And I wish you all the success that you all deserve. We also have some. I'm very happy to say that this is our 10th annual Traders Outlook. We started doing this 9 years ago, and this is our 10th year. And I hope we can do this for a longer period of time. Just to explain to the newcomers, the ones that are joining us for the first time, is what we do in the yearly outlook. We take a global look at what happened in the markets during the previous year. We analyze the fundamental events. We analyze the political events. We take a general look at what happened last year so that we can gauge and have a general outlook to the major trends that we are able to identify and try to pick the strongest trades, the ones with the biggest trends. And the beauty of doing this at the end of the year is when we are able to identify the major trends, we are also able to identify what are the corrective waves or the corrective moves in that trend, so that we use those correctives as an opportunity to take a trade in the general direction of the market, and use those corrective waves as an opportunity to enter into the trades at a better time and to maximize our returns in this way. So we identify the major trend, we identify the major direction, and by identifying those solid trends, we're able to see in those trends the corrective waves, and these corrective waves are buying or are an opportunity for us to take a trade in the same direction of the trend, and that's for affording us a better opportunity. In order to do so, we do a great deal of research, and you will see the amount of research that we've done here. And if anybody is interested in getting a copy of this research that I have done, I'll be happy to send that to you in the form of a PDF. All what you have to do is send us an email, and I'll be happy to send you a copy of that. I will be reading this summary, the summary of the research that I've done. I'll be going through it with you during this session, and you will be able to, if you want a copy of that, I'll be more than happy to send you a copy. So we deal in currencies. We primarily focus on currencies, but currencies does not work in vacuum. It is related very much to the geopolitical events related to commodities, relating to economies in the world. And in doing so, we're going to start by taking one economy at a time. So the first economy we're going to look at is the US dollar. And the US dollar is by far this year the strongest currency. And in order to summarize or give you a general perspective of what is happening with regards to the US economy and the US dollar, I think the best thing is to take what Yellen, which is the chairman of the FOMC, has stated in her last press conference and in their last communique for 2014, it will give us a great deal of insights to what the U.S. economy is doing. So, first of all, what she said, and that was the key statement or the key word that everybody hanged their heads on in the last press conference, was the word that patience has replaced in the language they previously used regarding how long the Fed might take before allowing the Fed funds to rise. That word, changing that, the word to patience, has been a word that has, for one particular reason, has taken a great deal of meaning this year and has put a great deal of bid or buying underneath the dollar. It also, in the statement, they also mentioned how important the improvements in the labor market is happening in the United States, and how important, or the great weight that the FOMC is putting on the labor market and the solid gains, and that we're having now lower unemployment rates. On balance, a range of, and these are quotes from the statement, Labor Commission indicates that the underutilization of the labor resources is gradually diminishing, and it continues to diminish. Also, that household spending is rising, which is a very good thing for the U.S. economy. They have identified that the household spending is rising moderately, and businesses' fixed investment is advancing, while the recovery, we have some small recovery or weakening recovery in the housing sector. Inflation has continued to run at a lower rate than the long-term objective, which is the 2% that is required. And what they said, that this is consistent with the statutory mandate that the committee seeks to foster maximum employment and price stability. The committee expects that with appropriate policy accommodations, and these are the words that I highlighted, and I'm going to come back to them in a minute, but I want you to see what the importance or the weight that we need to put on certain words so that we can identify the opportunities in our trading. They're talking about the maximum employment, price stability, and the committee expects with appropriate policy accommodation, economic activity will expand at a moderate rate, with labor market indicators and inflation moving towards the levels that the committee judges as consistent with its dual mandate, which is the dual mandate of the FOMC. So if we go to look at the unemployment, for example, the chart that you see here, this is the average weekly initial claims for the unemployment insurance in the household, and this is courtesy from the board, the conference board. This chart is an inverted scale, but this goes back to 1958. And as you can see here, I mean, I think it would be much more reasonable or much more easier if we look at it this way. I'm turning it upside down. And I turned it upside down for a reason, so that I can make it easier for you to view. As you can see here, that the highest unemployment that we had was during the 2008 period, and also back in 1982. I mean, I know it's upside down, but I'm pointing it this way, and then I'm going to turn it around for you to see. And what's happening is in 2008, we had an average weekly unemployment, or the average weekly claims, of about 650,000. That's 650,000. And back in 82, we had about, again, 650. And as of late, the unemployment has reached a level of about 200 and let me turn it back around because I got confused now. I'll turn it back. It's easier to go back this way. This is easier. As you can see here, because of the date. No, this is the wrong way. All right. Just this is the amount of the unemployment. And when it gets here, this is the worst, the highest unemployment that is being, of insurance claims that's being done. And the lowest is here. I mean, this is 200,000. This is the lowest. And right now, as we stand at this point, we are averaging about 295,000. Now, you can see that during the worst in 2008, at the peak of the crisis, the average was around 675,000 applying for weekly. And back in 1982, which again during the Reagan time and the oil crisis in the back, at that time in 1982, we had about the same number of 675,000. Now, when you see this rising here, this doesn't mean that the employment is rising. It means it's an inverted scale, so it means it's declining. But this here, the reason I have put this chart for you is that there is a major issue that we can take from this chart. In 1982, here, in 1982, at this area here, the population of the United States was averaging about 200 million residents. And at that time here also, if you look back in 1968 at this area, where the unemployment rate or the weekly unemployment was around 200,000, at that time the average population was about 115. When the population today is around 350 million, and all what are filing for unemployment is only 295,000, if this means anything, or this should indicate anything to us, it should indicate that with twice the number of population, we're still getting a very low unemployment rate. Log in, log out, and log in again, Andrew. And the log in, I mean, if you can't hear, everybody else is hearing. So with this kind of numbers, with this growth in population and decline in the weekly unemployed, this shows you how strong the economy is getting and the amount of jobs it's creating and the amount of capital that is coming in to the market. And that by itself, that kind of, if you relate the population and you relate the amount of unemployment, it can show you what is happening, truly happening in the U.S. economy. The other thing that we need to look at also is the amount of, which is the monetary base. And the monetary base, it shows the amount of money that the United States or the Federal Reserve or the U.S. government is pumping into the economy. And back in 2010 or so, the amount of was about $4.15 trillion. Lately, or the last indication that we have, that it has declined to 3.7 trillion. 3.7. This thing has shrunk by $500 billion. This is the amount of money that it's being pulled out of the system. And this is one of the fastest rate of the decline in the monetary base, and that is also another very strong indication of the U.S. economy. Khalid, please could you tell there is somebody that can't hear, could you tell him to log out and log in again, please, Khalid? And with that, you can see the strength, as I said, in the U.S. economy. Now, what they said in the FOMC is that in order to support the continued growth towards maximum employment and price stability, the community has refrained or decided to keep the 0.25% target rate for the Fed funds, and that is to be appropriate. But the key word that I want you to focus on here is this, that this assessment will take into account a wide range of information, not just economic, not just employment. It's going to take a wide range of information, including the measures of the labor market conditions, indicators for inflation and inflation expectation, and this is the key, and reading on the financial development. What does that word mean? It's very obscure, but it speaks volumes, because the United States is not living in a cocoon. The markets are global, the economies are very much interconnected with each other. If something happens in China, if they sneeze in China, it affects the US market the next day. So the markets are very much interconnected, and they react very much to what's happening in the world. So that reading of the financial markets, everybody now has been talking about the United States needs to raise interest rates, they need to do to bring in the yield curve, the yield rate. All this stuff, all these pressures that are set on the Federal Reserve, to the extent that all what the Federal Reserve did in its last communique, and this is what I put in the first PowerPoint, is they changed the word to patience, that they will be patient. And by doing this change in verbatim, the dollar flew. Everybody's trying to pressure the U.S., the Federal Reserve Bank, to raise the interest rate. And the Federal Reserve is telling us now that there is readings on the financial development across the globe. And why? Because the United States is trying to come out of the crisis. It's not yet reached the other side of the crisis. We have navigated in the United States a great deal of the storm. We are at the tail end of the storm, but we're not out of harm's way yet. In order for us to get out of harm's way, all the global markets need to reach the same level of safety, of economic safety, as you will, as much as the United States, so that any action that the United States can take would not affect the other global markets or will not have an adverse effect on its own economy. With that said, the Fed has stated that they are totally data-driven, and they will be patient when it comes to interest rate, and it may raise it more swiftly if it happens, or it may not. And with that case, we have no problem with either way, because this is the right thing to do, and this is the right way to, or the right policy to adopt and to embrace. And with that, we take a quick look now at the chart for the US dollar and see the effects of what's happening in the US dollar. We are going to look at, because we're trying to get the big picture, and the reason is for looking at the big picture, and what I told you in the beginning is to be able to identify, is to be able to identify the major trends and at the same time identify the corrective waves in those trends. If you look at this weekly chart or even the monthly chart for the US dollar, as you can see here, technically we have broken above the structure point in the US dollar. And now we're beginning a bull leg to the upside. And then pretty much the next target or the next significant point on the US dollar should be around the 93-94 area, 94.11. But what I want you to see by trying to identify the corrective waves, as you see on a monthly, we have a very strong momentum with a bull leg continuing higher. If you look at the weekly chart, you can see that this is your bull leg and this is what we call your corrective waves. These are your corrective waves. These are your corrective waves. These are pullbacks. They are not change in the market direction. These are not that everything that I've said about the U.S. economy, the unemployment, the employment, the cutting of the monetary base, all that is not going to change overnight. This is a trend. The economic growth, the U.S. economy is growing. It's a trend. It's not going to change overnight. So if that is not going to change, these are corrective waves. And these are what we're looking for, and these are our buying opportunities to buy the dollar so that we can continue to hold it in the trend. If I minimize it to a daily chart, you can see how big those corrective waves are. And these does not mean that the dollar is going to crash or anything. These are nothing more than mere buying opportunities for us to join into that, to jump on the trend. So we definitely now want to buy the US dollar. The fundamental story that I shared with you is now being confirmed by the technical picture. We do have, if you look at the daily chart, there is your higher low, there is your structure point, and there is your momentum leg, and we're pushing. The next target for us is going to be the 94.11. This is the dollar index. This is the dollar index, which is a basket of the US dollar versus a group of currencies, all the basic currencies. And this one gives us a better view of, yes, it's being recorded and you're going to, it's being recorded. So anyway, this basket or index it gives us a clearer picture. It gives us the true power of the US dollar versus the whole currencies, the rest of the currencies. And we do that, the dollar index, the yen index, the euro index, every single one of them. So the fundamental story that I shared with you is very strong, and the technical picture that you see here is powerful. This is a screaming buy. If you look at the weekly, that is a screaming buy. And of course, on the monthly, we did not have one single negative month in the last 1, 2, 3, 4, 5, 6, 7 months. Every month for the last 7 months, we had a positive close for the US dollar. So this to us indicates that the dollar is extremely strong. The technical picture confirms the fundamental picture. So now the decision is we need to buy the dollar, and we need to identify a place where we can buy the dollar. And the way for the newcomers, the way we do things here is we give a grade to each currency, and that grade is a measure of its strength, and then we try to match it with another currency which is weaker. So we match the strongest with the weakest. So the strongest currency we have today is the US dollar, and the strongest measure we have, we give it 3 pluses. That means it is very strong. The weakest currency, we're going to give it 3 minuses. And when we, let's say, for example, the euro, I'm just giving, for example, to explain. So if I wanted to choose a pair to trade, I'm going to match the US dollar, which is the strongest, and I'm going to match it with the weakest. And I'm going to match the strongest with the strongest, and then I'm going to match it with the second weakest, and so on and so forth. So the strongest currency we have today is the US dollar. That is the strongest, and this would be the one that we need for the immediate future, for at least the next 6 months or a year, is to be buying the US dollar versus the other weak currencies. Now, the most important thing is to repeat what I said before, is once we have a pullback in the US dollar, this does not mean that the dollar is crashing or it's coming down. All what this means is this is a corrective move, and it's a good buying opportunity for us. So we should be looking at these corrections with joy, because it gives us a chance to jump on the trend at a better price point. So with that said, we are going to, as I said, we're going to look at buying the US dollar as the strongest currency that we're going to be doing. That's the first choice, is buying the US dollar. The second currency we're going to discuss is going to be we'll take a quick one. We're going to take the Canadian currency, the Canadian dollar. The Canadian dollar is closely related to the US market, and once the Canadian dollar or the Canadians have realized that the US is not going to be in a hurry to raise interest rate, the rates in Canada are equal or just above those we have here in the United States. And as long as, and this is the key, as long as crude oil does not plunge, money at the margin will seek investment in Canada. So the key point behind the Canadian dollar as a commodity currency is the prices of oil, the price of gold, the price of grains, because it's one of the bread baskets. It is a commodity currency. And what has happened is that the oil, and we're going to discuss oil in detail in a minute, but as you can see that this is the chart for the Canadian dollar. As you can see that oil, as you all know, has been capitulating, and I will show you a chart for the oil now. This is a chart for the crude oil. This is a continuous monthly chart for crude oil. It was trading at 110, and now it closed the week at 52.57. It lost about 40% of its value. And of course, that effect, as you can see here, is going to have an immediate, I mean, this could be a mirror image for the chart of the crude oil to the chart of the Canadian dollar. As you can see, the chart of the Canadian dollar on a weekly basis is pretty much mimics the chart for crude oil. And with the continuous decline in crude oil, that is going to put, and the same thing with the grains, the same thing with the gold and silver, it's going to put pressure on the Canadian. And if you look on the daily chart for the Canadian dollar, you can see that it capitulated on Friday tremendously. You can see the capitulation. This came down about 250 pips, or what we call close to 3 big figures. And 3 big figures in a day, this is a tremendous, tremendous move. And with that, since it's such a move, and this happened on Friday, and the markets were pretty much very thin, we're going to take that close with a grain of salt. But this doesn't change the fundamental picture behind the Canadian dollar, that it is weak, and therefore we are going to be looking at the Canadian with a negative bias. We're going to be negative on the Canadian. So that is the dollar. For the CAD, we're going to be, the Canadian economy is good. Everything, I mean, technically it's good, but it's suffering. So the Canadian, we're going to give it 2 minuses because it is weak, but it is not very weak. So this would be the CAD. So we're going to give it 2 minuses. The next one we're going to look at is pretty much the euro. And the euro is in quite, let me change the screen. The euro now is suffering a great deal of difficulty, and there are several things that are playing now with regards to the euro. The first thing, which is the big deal, is Greece and what's happening in Greece. They have a rather awkward presidential election. The elections in Greece are, or the presidents in Greece are chosen by the parliament. They are not chosen by the public. It's a ceremonial position, but it does have a great deal of responsibilities. And the prime minister usually calls and puts forth one candidate, and the members of parliament would choose the president. And according to the constitution, he has 3 times to do that, and he must get about 185 votes in order to get the president. So far, for 2 elections, he tried that twice, and he has failed twice. And I think the next election is in something coming up next week. And of course, if he fails to install a new president, what's going to happen now is that the parliament is going to be dismantled, and the new parliament is going to be elected, and that, of course, is going to wreak havoc on the Greek situation. The issue here is that the second party that is running in the election, they call it the Snasia party, these guys have came up and they made a great deal of promises to the electorate so that they can win the elections. And the first thing they said is that they are leaving the euro. They're going to that, and they called it the Greek exit. The Greek exit. That is going to be the Greek exit. They are going to exit from the euro, and that they are going to ask for forgiveness on debt. they are going to try to pay in drachma. They do not accept the austerity measures that is being forced on them by the Troika, and they're going to leave the union. A great deal of a storm resulted into those after those comments, and the vice president of the representative to the EU Parliament came out and said, no, we have no intention of leaving the euro, we're going to stay. And this is what he exactly said, quote unquote. There is absolutely no case for a Greek exit, and those who invoke such a possibility play on the propaganda game against the Greek and the European economies. Although our members respect the party's decision, which are pretty clear, we will seek a solution for Greece within the Eurozone. This is something that is being directed to the political or to the nations, or to the, but it's completely different than what they have said to their electorate or to their constituents. And this remains to be seen. What they're trying to do is to remove the fear from the market, and this kind of rhetoric to remove fear can only last for a few days or a couple, maybe a weeks, until something begins to happen. The important thing here to note is that Greece has to pay at the beginning of this year, I was doing this, 6.7 billion euros. They are due this month. And simply put, Greece does not have that money and will not pay, especially if the economy remains weak as it presently is, and it's more certainly will continue being that weak for the next months to come. Also, the Greek have offered broad tax relief or tax cuts to its populace. It has promised to increase the minimum wage. They have promised moratorium on debt payments incurred by individuals from the nation's bank. So basically, if you owe money to the bank, you have a moratorium to pay, and that would be up to 20% of the disposable income and pensions for everyone above a certain age. And we're not sure what kind of age they're talking about, but it's as long as you're still not too old, and that would be about 750 euros a month. These ideas are, frankly speaking, preposterous, and these demands cannot be met and will not be met. And these are the program that the Caesarea party stands for, and they will be pushing it. And if they do win and they start pushing this, the situation in Greece is not going to end well on the euro and on Greece. Moving on, we go to what the ECB has stated, and we draw your attention to what Mr. Bonnet, what's his name is, a member of the executive board of the European Central Bank, in an interview he did last week with the Wall Street Journal, and he said that the bank is moving inevitably towards large-scale asset purchases, other words known in the modern world for you and I as quantitative easing. He made that statement. And concerning the need to sponsor inflation in Europe, he said that a broad consensus around the table in the Governing Council is that we need to do more. That is regarding inflation. And to translate this in simple English, what can a central bank do more with regards to inflation? The only thing they can do is printing money and pumping money into the system. So if you've seen the monetary base in the United States coming down by $500 billion, That, in other terms, if you want to translate this in monetary lingo, this means they're going to pump and they're going to increase the monetary base for the euro by at least $500 billion. And regarding what more shall be, what he said also, which is very, very significant, is that they may look at the purchase of sovereign debt of some sort. This is a very important point to take in to be aware of, because what does that mean? A sovereign debt is notes issued by a sovereign nation. So the United States, when it sells bonds, these are sovereign debts. It's the debt of this nation. So a sovereign debt would be Greek debt. That's a sovereign Greek debt. Would be British debt, would be French debt, would be German debt. These are sovereign debts. And this is a roadblock that Germany does not want to accept, because now they are supporting the euro. In this case, if the euro decides to buy Greek debt, now they have double exposure to the Greek economy. And this is the roadblock that Germany is putting in front of the ECB, is they're not allowing the purchase of sovereign debts because they don't want to take individual country risks. They want to accept risks within the global umbrella of the ECB, not towards individual countries. So it's not that much a question of whether we should do something, but more a discussion of the way to do it. This is what he said. If we want to do more, we obviously have to reach out to market segments where there is more liquidity, i.e. sovereign debts, and that is why government bonds is the baseline option, which doesn't necessarily mean we would buy only government bonds. You might be looking at mortgage-backed securities or whatever. What could be, there is nothing that could be clearer of that from his point of view, but that is always the issue of Mr. Wiedemann, who is the German guy, who is going to be opposing to that hand on foot. Also, just to give you another idea of the difficulty with that situation, is that if you are going to look at the general government debts as a percentage of the GDP, in 2007, the Greek debt was 105% of the GDP. So they owed about 105% of the GDP. In 2014, that is about 170% of their gross domestic product. Portugal was 65%. Today, it's 125%. Italy was 90. Today, it's 115. Ireland 20, now it's 90. Spain was 25, now it's 70. On average, the average ratio was 65% to the GDP. Today, it's 115% between all those European nations. The only country that is not really, its debt did not increase much to its GDP is Germany, even though its debt has increased by 5%. That is not, and this, if you look at these numbers, you can understand where Germany is coming from. We do not have France here because I couldn't find the data for France for the time being. But one thing about France that you need to be aware of is that in December, their jobless claims were increased by 24,000, and that is to a new all-time high. Exactly, it's getting there. It's getting there. I mean, I'm not yet finished with the, but there is there is some light at the end of the tunnel. I mean, it's pretty gloomy, but there is some light at the end of the tunnel. But this is here another crucial point which is happening in France. They have reached an all-time having 3.4 million unemployed. Right now, 3.4 million unemployed. And this is the highest in history. And this monthly unemployment has risen for 3 consecutive months, while their GDP has only grown by 0.4%. So now you see what's happening in the rest of Europe, and now you see what's happening in France. It is quite a very gloomy picture. And the point I would like to share for you, it is scary, but here is the point, my friend. We are traders, okay? When I do all this research, I'm not trying to present myself to you as an analyst or a financial analyst. I did my research, I looked for this. Most of this is information I put together from sources I trust. And we do that as traders for simply one thing, is that we're not going to put our hand in the sand, our head in the sand, and not to be aware of what's going around us. We calculate or we accumulate all the fundamental analysis that's available that is being done by smarter people than us, who are more smarter and they have more access to information than us, and we funnel all this information, and then we take this perspective. You said it looks gloomy, I agree with you, but we take this information and we look at the charts and see if the technical picture confirms with the fundamental pictures. So we want that the technical picture confirm or either agrees or disagrees with the fundamental. The final way we are going to trade is following the charts. We are technical traders. If the technical picture confirms the idea or the opinion that we have accumulated, fine and well, we follow the chart. If the chart disagrees with the fundamental analysis, then we are going to disregard the fundamentals and we're going to go with the technical. Because the chart is the voice, the price. I mean, this is why we call price behavior. And what price behavior is, it is the movement of the price. When I say price behavior, just a quick hint for the people that are joining us for the first time. Price behavior does not mean the zigzag. Does not mean the zigzag in this price. That's not price behavior. Price behavior means what makes this price go up or what makes this price come down, and how does this move up should look if we are right, and how should this move coming down should look if we are wrong. Because this price action that you see, why would you think that the dollar should go up like this? Why would the dollar rise to this extent? From July of last year, from July 2000, in 6 months, this has gone from 80 to 90. This has gone up by 25% in 6 months. Anything that moves up price or pushes the price down is supply and demand. It's simple supply and demand. More people wanting to buy the dollar. That's why they are competing and chasing the dollar, and they're willing to pay a little bit extra every day, and thus resulting in this move. That is the behavior of what we call the smart money, the intelligent money, the high net worth client, that they're trying to protect their investment, their net worth. They are getting out of the euro and they're going into the dollar. By doing this kind of action, they are behaving in a specific way. And that is the behavior we identify and we see. So we might, if we have an opinion, but this chart that you see contradicts with our opinion, we will set our opinion aside and follow the chart. because this is the instant truth. This is the sum total of all the wisdom. This is the sum total of all the wisdom and of all the ignorance of those who are dealing in this instrument. This price here is that sum total of that wisdom. And this is one thing we should never, ever argue with that wisdom. So we have to follow that wisdom. So with that said, what are the, and if we look at the chart for the euro index, if you look first on the monthly chart so you can see, this is a very ominous view. And once just to go back to the point I didn't finish the first point. When I said we're traders and we follow the technical perspective, our job here is to make money. So yes, it looks bad for the euro from a fundamental perspective, and looking at this chart, it does look very ominous and very bad for the euro. So that puts our mind at ease. Our job is to make money, so we're going to be shorting the euro. That's what we're going to be doing, is shorting the euro, because I have a technical picture that confirms the fundamental picture. What we have here, ladies and gentlemen, is what we call a structural failure. By trading below the 121.04 based on the index, not the the euro dollar, but this is the euro index, which is a basket of currencies against all, we have now a structural failure. And that should be the beginning of a bear leg to the downside. And the next possible target, or the next pause, should be somewhere around here. And you're looking at parity. You're looking at parity, which means 1 euro for equal 1 US dollar. This is pretty much what we're looking at now as the next possible target here. And that is the technical look. So we have a technical picture that confirms the fundamental picture. So now we're going to be bearish and very bearish on the euro. So we're going to go back to our original dollar chart, and we're going to give a grade to the euro, and the grade to the euro is going to be very bearish to the euro, and we're going to be extremely negative to the euro. So we have slightly bearish to the CAD, we have very bearish to the euro, and very positive to the dollar. We're just going to get to that 1 second. I mean, we're going to do the individual pairs in a minute, but right now we are doing the matchup. We're doing the matchup. So just give me 10 more minutes, and then we're going to take a break and come back and do the individual currencies. Okay? So that is the euro. The Swiss franc, our dear Swiss franc, is one of the victims of the euro. And as you can see, we do have a technical structural failure to the euro, to the Swiss, and this thing is going to move in tandem with the euro. For every point the euro comes down, the Swiss is going to come down with it. And it has nothing to do with the Swiss economy. It has nothing to do with the, they do have some challenges, but the proximity of Switzerland being in the center of Europe, with its economy closely linked to all those European economies, the Swiss National Bank has decided, or has declared, that it's going to maintain the Euro-Swiss exchange rate of 120 for the euro. And as you can see, I mean, if you want to see central bank intervention, there is nothing clearer than this. This, ladies and gentlemen, if you want to see central bank intervention, this is central bank intervention. They are supporting the euro. They don't want it to come below the 120 level. And as you can see, from 2012, for the last 2 years, nobody has been able to push it below the 120 level. And so far, to the best of my knowledge, that the Swiss National Bank have spent close to 60 billion US dollars. And the governor of the Swiss National Bank has announced, without mincing any words, that he has unlimited resources and he's not going to allow it to go below 120. And with that said, this means that the Swiss is going to be as weak as the euro. So we're going to give it the same grade as we're going to give to the euro. So the Swiss is going to be, again, as bad or as weak as the euro. We don't care bad or good. Weak, we sell. Good, we buy. Okay? Now we come to the two other commodity currencies, which is the Australian and the New Zealand. And as you can see, again, this is the monthly chart. And for you that attend with us the planning session every Sunday, we have identified the structure point at 84.47, and we have broken below the that structure point. And there is a growing concern, and I'm going to read it for you so that there is a growing concern that the Royal Bank of Australia and the Royal Bank of New Zealand will move to cut interest rates in February, in the next month. They might be looking to do that. And those concerns were brought about with the continued news about the dairy product in New Zealand, and such concerns about iron ore prices for Australia, the decline of iron ore prices, and the decline in the mineral in Australia and the dairy products in Australia is definitely having a great impact on these economies. And with the interest rate being 3.5% on the New Zealand and 2.5% or 2.7%, or I think 3% for the Australian, is putting a double whammy effect on the Australian dollar and on the New Zealand dollar. The Glens and Stevens of the Royal Bank of Australia and New Zealand respectively have announced, without mincing any words, that they will look at the Australian dollar to come down to the 75 and the New Zealand to come respectively. Oops, where am I? So with that, we're looking at the Australia, according to what Stevens said, is looking at 75, somewhere here. So we have to take them at their own word. So with that, we're going to be as bearish, but we're not going to give the same degree of bearishness that we have for the euro and the Aussie to the Aussie and the New Zealand, simply because they do still pay interest rate. So by they paying higher interest rate, there will be some capital inflows coming in to the Aussie and the New Zealand. So we're going to be negative on the Aussie and New Zealand, but not as negative as we have on the euro and the Swiss. So for the New Zealand, we're going to be, let's say, double, a higher or a lesser grade. We're going to be as negative as we are with the, okay? That is, last but not least, is the granddaddy of all, which is the Japanese yen. So we are now at the top of the hour. So let's take a 5-minute break, and we'll come back, do the Japanese yen, and do the British pound, and then we can start doing our items. So let's take, I will do all of that, Ernest will do that. So let's take a 5-minute break. Let's come at 5 minutes past the hour, and we're going to do the index, the S&P, and we're going to do gold and silver, and all that kind of stuff, and the British pound. So let's take a 5-minute break and then come back and do the rest, okay? As I said, we're going to be negative on the Aussie and New Zealand, but not as negative as we are on the Euro and the Swiss, simply because the Aussie and the New Zealand do pay some interest rate. And once they do, people, especially the Russians, the oligarchs and all that stuff, they are getting their money out of Russia, and they need to put it in an interest-bearing economy so that they can get some interest. And the only two places that they can put this money in is either in the Aussie or the New Zealand. So you can expect very volatile moves in the Aussie and the New Zealand simply because it is going to be subject to either capital coming into the market and capital flowing. So the way we trade the Australian is like this. The way we trade the Aussie and the way we trade the New Zealand is you are looking for any corrective move. If you look here, this is the Australian dollar, the Australian index. So any move to the upside, any move like this, this means that there is capital inflow coming into these currencies. You don't really want to buy there. What you want to do, you want to look at these here as opportunities to short these currencies. So any move of 1 or 2, 3 days to the upside is usually followed by a capitulation. So, and this thing should be continuing to the downside. The same between the Aussie and the New Zealand. The one thing, the last thing that, or the last currency that we are going to discuss is the Japanese yen. And the Japanese yen is a very interesting situation. And the reason it is that interesting is what happened or what is happening in Japan during the last couple of years, which is what they call the Abe economics. And the Abe economics is basically, Abe who is the Prime Minister of Japan and who is very well supported by Kuroda, who is the governor of the Bank of Japan, has decided that they are going to do everything in their power to change the Japanese economy or to take it out of its deflationary state and try to generate inflation. The Japanese economy has been suffering from deflation for the last 25 years, since mid-1990s. And what deflation means, it means that the local prices decline every year. So if you have a car in Japan that is worth $10,000, equivalent of $10,000, next year it is going to be $9,000. Everything decreases in value every year. That's deflation. And the following year it is going to be $8,000. And the following year it is going to be $7,000. That is what happens when there is deflation. Now, think of it as a Japanese consumer. If today you wanted to buy a car and this car is being sold today for $10,000, you would say to yourself, I will wait to buy it next year because next year I can buy it at $9,000, so I'm saving $1. And if you decide to wait for 2 years, you can buy it at $8,000. And something like this, if you look at it from a point of view of a Japanese consumer, well, heck, you're saving money, you're going to put your money in the bank, and you're going to refrain from consuming, from buying. And once you refrain as a consumer, that's good for you in a way. It's not that particularly good because your currency loses value, but If you look at it as a Japanese producer, as a car producer or as a TV producer or whatever, you find that your Japanese customers are not buying. Why? Because they're waiting to buy it next year at a cheaper price. So what would you do? You're going to shut down your production because the demand is declining. You're going to shut down your production. You're not going to hire more workers to produce more. You're going to shrink. You're going to shrink your industry because there is a shrinking demand. And that's what's happening in Japan. So what he's trying to do is trying to do the opposite. He's trying to create inflation. So today, if something is worth 7,000, next year it is going to be, because of the inflation, it's going to be worth 8,000. And if you wait another couple of years, it is going to be worth 9,000. Therefore, as a consumer, that inflation is not too good for you, because this means if you wait till next year, prices is going to go up. So you rather buy today at 7,000 because next year it is going to be 8,000 and the following year is going to be 9,000 and so on. So from a consumer point of view, it is not the best situations, but from an industry and economy situation, it's fantastic, because now with having a small controlled inflation, the producers now know that next year demand is going to go higher. They're going to hire employees. They're going to reinvest in their industries. They're going to build more factories, and the economy is going to grow. So inflation is as long as it is controlled, it is a good thing. And that's what he's trying to do. He's trying to change it from being a deflationary situation where the prices come down. He's going to try to turn it into an inflationary situation where the prices increase, and therefore the industry will increase, more employment will happen, and all that is going to be good for the economy and for the Japanese economy in the long run. In order to do that, he has three tools in his hand. One, he needs to lower the Japanese yen. By lowering the Japanese yen, the value of the Japanese yen, he is inadvertently raising the price of what the consumer will have to pay. Because if the yen value buying power shrinks, then the value of the assets is going to go high. So by lowering the price of the yen, he's inadvertently or indirectly raising the price of the car. If a car is worth 700,000 yen, if he lowers the value, the car will be now worth 800. So one of the tools that he has in his hand is lowering the cost. The second thing he's trying to do is investing in infrastructure and public projects. And by doing so, he is going to invest more money in the public sector, if you will, and therefore he's creating more industry, he's creating more infrastructure, and therefore more people will be employed, and the economy is going to grow. The third quiver in his three arrows that he calls is changing the public perspective. And in the case of deflation, which we have here, as you can see, the point of view of the Japanese consumer is not to spend, is to save. Because now if I don't buy at 10,000 and I wait for a year, it is going to be worth 9,000. And if I don't buy it at 9,000, it's going to wait, and I'm going to wait, it's going to be worth 8,000. And this is a mindset. This is a mindset that people have been ingrained in their heads for the last 25 years. So he needs to change that. He cannot do that by a stroke of a pen. He cannot do that by making a statement. He cannot do that by public investment. But what he can do is by lowering the value of the yen and making the Japanese consumer fear for his net worth and for the buying power of the Japanese yen that the Japanese consumer would rather spend now to buy and put his money to this safe. Okay, I'll explain that for you in a minute. To this safe and start buying. The question that the gentleman is asking, how does lowering the value of the yen change the prospect? Assuming you're a Japanese guy, you have in your bank account, let's say 1 million yen, which is equivalent, let's say, to I think is equivalent to $10,000. That is your net worth. That is your buying power. Currency is buying power, which you can buy with it. Let me ask you a question so that I explain. Who is richer? Who is more wealthier? Who is richer? If I have £1 million or $1 million USD or €1 million, who is richer? The guy that has £1 million or the guy that has $1 million or the guy that has €1 million? The guy that has £1 million, because you always related pretty much to the dollar. Exactly. Why? Because the dollar is equal 1.56 million US dollar is equal to so on. So it's, and the reason when I say richer, it's basically the buying power. You can buy more with £1 million than you can buy with $1 million US dollar, or you can buy with €1 million. Okay? And if I said I have $1 million Japanese yen, the guy with the $1 million Japanese yen is the poorest guy, because the $1 million Japanese yen is pretty much nothing compared to £1 million. So keeping that in mind, if the starting point is 1 million, you have $1 million yen, which is equivalent to $10,000, you can buy stuff with this. You can buy stuff. Let's say you can buy a car, a $10,000 car. You can buy a car for $10,000. That's what you can, that's your net worth, that's your capital. Now, if the Japanese yen declines in value, so if the 1 Japanese yen, the 1 million Japanese yen, loses, let's say, 20% of its value, okay, is now equal to $8,000, okay? The car that you want to buy is still $10,000. The value of the car hasn't changed because they're buying raw material, they're buying equipment. If they sell it less than $10,000, they're going to lose. So the car remains at $10,000. So in this case, you can only buy 0.8 of a car. You can't buy the car with the 1 million. Why? Because you lost 20% of its value. If you waited for another year, that 1 million yen is going to be 0.6. So now if you wanted to buy the car in 2 years, you need 2 million yen to buy a car which is worth the same $10,000. You need to pay twice as much. It's going to cost you twice as much. So by lowering this value, lowering the value of the currency, it's going to make the guy say, I'm not going to wait until I lose 50% of my buying power. I'm going to buy it now. And by buying it now, he's going to stimulate the economy. This change takes a while until people perceive that the longer they hold on their money, the more they're going to lose. And that the depreciating value of the currency is going to work against them rather than working for them. Okay? Does this answer your question? And that is what he's doing. He's using this as the tool to. So he had the election last year. He has the election last year, and basically the result of that is the following. He has made the election and he won the election, and basically there was the effect of the election are primarily three things. First of all, he won control for the Japanese government for the next 4 years, and this is a fantastic thing because this means that he's going to be the longest standing prime minister in the last century, and he's going to be in position until 2018. And stability, he is going to be breaking stability because he wants to make sure that his policies are going to succeed. So therefore, that stability is going to be a good thing because that means consistency in the policies. The second thing he did was he postponed the sales tax that was supposed to be imposed next April. He postponed it till 2017, and he inherited this tax increase from his prior government. What the prior government was trying to do was to generate revenue to finance its debt, and Japan is the largest debtor in the world. So they are trying to raise taxes, but of course when they raise taxes, in addition with being in a deflation, it had a double whammy, and it pushed the Japanese economy into recession. It brought it back more towards recession. So this was not the best thing. And the weak yen, which is the first or the last in the arrows, has served to make Japan far more competitive in the global export market, and we can reasonably expect to see him push the government and the Bank of Japan further along that line to push the weaker Japanese yen. So with that, we can look at the dollar yen to go towards the 135, the 125. We're going to look for this to continue higher. And as I mentioned, he has the support of the Bank of Japan. And of course, nobody in his right mind can even consider talking about stronger Japanese yen. So any decline in the Japanese yen, and this we're going to see when we're looking at the dollar yen and the pound yen, etc., is actually for us a buying opportunity. The third problem that Japan has is demographics. It's an aging nation, and the unemployment there is reasonably not that good. So he needs to push and make the Japanese currency, or the short answer is to mandate the decline. It has been deflationary in the last 25 years. Okay, so the Japanese government lately has approved a $29 billion fiscal stimulus, and the way they are going to do that is that they're going to boost the regional economies. They're going to use $1.7 trillion in public works to fix all the damaged stuff from the disasters and all that kind of stuff. And they're going to put some extra budget. And the government, and the key date here, the reason I'm showing you all of that is this, is the date. This is going to be on January 9th, next week. This is going to be voted upon and approved by January 9th. And of course, from here till January 9th, as we know, we need to follow the smart money. They are either going to push the yen weaker in anticipation of this vote, or they're going to create an opportunity. So we're going to have to keep our eye on our entry points with regards to the Japanese yen entry point. But there is no argument or quibble against for the direction. There is no argument. We should not take up any arguments with regards to the direction in the Japanese yen. With that said, we're going to look at the chart for the Japanese yen, and I have another chart which I would like to show you, which is a very important chart. And this is the chart for, can you see the chart for the Japanese yen, the monthly continuous contract on the Japanese yen? Can you see it, guys? It's a white chart. Okay. This is a chart, the continuous contract for the Japanese yen. And as you can see, one of the glorious times for the Japanese economy was pretty much in the mid or to the late 90s. Okay, and as you can see here, the worst part for the economy was when the Japanese yen was trading at the peak, which was pretty much in 2012, 2008. This was the peak over here. And now when Abe came into power, this is when Abe came into power. And as you can see now, the decline. And there is this tremendous momentum to the lows. And now we broke the second structure. So the way, by looking at this chart, looking for technical places where we can see where the yen is going to stop, the first level would be somewhere here around the 80 level, but the technical stop should be around the 75, 74 level, but reaching back to that level around the 65. This is pretty much where Abe hopes to get the Japanese yen to. This would be the pretty much the target area here around the 65, between 65 and 70 based on the index. Now to translate this to the dollar yen, this is what we need to look at. If we're going to look back to the date 98, 90, looking back at the 97, 98, this is the area we need to look. This is the dollar yen. It's this area over here. And we're looking very easily to the 135 level and the even 145. And pretty much this is where he's hoping to take it, which is in 98, 147. We are sitting at the 120. We have about 20 big figures left. 20 big figures. This is not going to happen in a week or 10 days. This is going to be the long-term trend. It's going to take a while. But we are going to look at the 124 level as an initial target. Then we're going to look at the 126 and the 135. If you're able to buy it from here and hold on to it, that would be the trade of the century. If you buy every pullback on the dollar yen, particularly the dollar yen followed by the pound yen, that would be the trade of the century, because the long term, we have now fundamental stuff followed and confirmed by the technical stuff. So there we have to hold on to that and stay with these kind of trades. There are two more points that I want to discuss before we move on. One is Russia and crude oil. The reason we're discussing crude oil and Russia is that the crude oil situation is pretty much the saving grace for Europe or for the Eurozone. It is pretty much the saving grace. And we have to be pretty much blunt here on what's happening in the market. Crude oil has plunged because of the higher production, because of the fracking, because fundamentally it's oversupply and there is less demand. I don't think there is too much less demand, but definitely there is a tremendous amount. There is a glut in production. And the United States is pretty much out of the import of the fracking, out of the market of importing oil. But as you know, the United States is not an exporter of oil. So the oil situation has two prongs. It is an economic prong, which means there is oversupply, and the United States is not buying from overseas as much as it used to buy before. Two, there is a political element to it, which again, the conspiracy theory about Saudi Arabia and Russia, and they're trying to hurt the Russian economy. I don't follow very much in the conspiracy theory, but there is a little bit of common sense coming here into that picture. And the common sense in this picture is one point, is that the United States, with its huge production that's coming online now, is not an exporter of crude oil. It doesn't export crude. It's against the law to sell U.S. oil outside the United States. So it buys I think 2 million barrels a day. So by it not importing the 2 million barrels a day, this 2 million barrels oversupply due to the lack of U.S. importation should not create the glut in the supply system that we are seeing right now. So there is more to it than just the glut in the supply. There is something more, and there is, I don't know what it is, and I don't profess for it, but we need to understand that so we can take this into our account in identifying the trades. So with this situation, and oil now trading at 57 actually today, closed on Friday at $57 a barrel, this is a very good thing for the U.S. market. It is a very good for the U.S. economy, because now the amount of money they spend for energy is going to be cut in half, and this would increase profitability, and it's going to allow them to lower the price. So it's good for the consumer, it is good for the industry, and it is also good for Europe, because now Germany, for example, instead of paying $100 billion a year importing oil from Russia or gas, is going to pay half as much. And that money can go into the budget, can go into and the same thing with Greece, the same thing with France. All the money that they would be pumping out to pay for energy, electricity, and all that stuff, they can redirect either in investments or whatever to save their economies, if you will. And that is pretty much the saving grace. We can assume that this is a good thing. I really can't understand what you're saying, but the idea is, the way we look at it as traders is as follows. It is good for the U.S. economy, so this is good for the U.S. stock market. It is going to be good for the oil importing countries. It is not good for the oil exporting countries. So, for example, UK is, in a way, oil producing, so it's going to suffer, and that's why the pound is suffering. Norway and Denmark and the North is going to suffer from the fall in the oil prices. Russia is going to suffer from the fall of oil prices. And also the other saving grace about the fall in oil and what's happening in Russia is no longer going to threaten Europe by cutting the natural gas. They need every penny they can get to pay their budget. So this is going to put some peace and tranquility for heating and keeping the people warm in Europe, and at the same time it's going to give a pump for the European economies, at least to lower their debt demand in the... Yes, of course, I'm going to put the British pound right now. So this is the Japanese yen. So again, the direction, this is, we have two very predominant, so far we have four predominant trends that we have identified so far. The dollar up, the euro down, the Swiss down, and the Japanese down. These are the predominant ones. Now we come to the UK. The United Kingdom actually is considered the third strongest currency or strongest economy in the world. But for some reason, it is the reports, for example, the sales report that came out of Britain in right after Christmas was remarkable. It was a staggering, I mean, they were expecting the CBI, they were expecting the number to be close something to 31, 32, but instead of that, it came out to be 61. These are staggering numbers. And it tells you that there is sales and the economy is working reasonably well, but the British pound is very much now close to what's happening in Europe, and it is suffering. I mean, they don't know what is going to happen to Europe. There is the talks about the referendum coming up in a year or two about, and the election. I mean, there has been, in all honesty, I mean, this is a classic situation. Like I was telling you at the beginning of the session, we're going to look at the fundamental stuff and then go look at the chart. If the chart confirms the fundamental stuff, okay, well and done, we're going to continue with it. And if it contradicts, then we're going to follow the charts, because the chart is the truth. If you look at the numbers that are coming out of Britain, it is reasonably good numbers. I mean, there is if you listen to the what's his name? What was the guy named? I just went blank. I mean, when they were discussing the budget, I think a month ago, and he was talking. Osborne, yes, thank you. I mean, the numbers were fantastic. Everything was really good. And Carney, they're talking about the economy. But if you turn around and you look at the chart, there is something that we don't understand that's going on. And if we look at the chart here, it is totally to the contrary of all the fundamental positive information and we're getting out of the British economy. Now, all what I can do and all what we should do, because we have limited resources, Keith, about these, what is ongoing. Yes, of course, looking in hindsight, it has been a lovely range. I totally agree with you. But as we stand right now, looking back in hindsight, it is a range. But going forward, we have to be looking at this with pretty much a real grain of salt. And so is it the effect of its proximity to Europe? Is it in effect one second, guys. Is it the proximity to Europe? Is it what they fear is going to happen as a regard of in the Eurozone? But what I would suggest to you here, guys, is the following. We, like Keith said in a minute ago, that this has been in a beautiful range for the last couple of months. And if that's the case, and I kind of agree with his assessment, this means that this is still in a range, because we don't have any technical structural failure to the upside or to the downside. It's still within the middle of the range. So we need to treat this as a range bound. As a range bound. When we are in a range, we're in a neutral zone. Okay? Until it breaks the 147 or the 148.32, which is the structural point, then we're still in a range. So we have to treat this with the neutrality of a range, because all the fundamental news is actually good. It is the second best after the United States, yet the price action doesn't confirm that. We need to take Friday, what happened on Friday, with a grain of salt. This is what happened Friday. We have to take that with a grain of salt. Why? The market was very illiquid. There was not enough traders. They were pretty much stop hunting for stops. And when you have the pound to come down 3 big figures of 300 pips, this is an extremely exaggerated move. And again, all what I'm saying is, if it's another day than Friday, the first day of the year, I wouldn't say what I'm saying. But I'm saying this now because it was a very thin market. Nobody was trading, and the desks were empty. And this is where they go fishing for stops. So looking at this looks negative, and it looks quite bearish. So we're going to apply our rules. We're not going to buy the pound. I'm not going to say, okay, this is going to stop, we're going to buy the pound. All what I'm saying is, we are neither going to buy the pound, nor are we going to short the pound. Why? Because this is an exaggerated move. This is what we call a distressed close. This is a distressed close. So only if it breaks below the lows, then I'm going, it's a big range day. Good. Well, I'm happy that, it's a big range day. So if it breaks below the low of the big range, then I'm going to short it. If it doesn't, then I'm going to stay on the sidelines until we assess the situation. But due to the consideration we have about the economic stance of the UK, we are going to give a grade to the pound of we're going to grade the pound as 1-. So if we are going to measure our grading system, so we know how we're going to buy or sell, definitely we are going to be looking, if we're looking at the weaknesses, the weakest is the yen, the weakest again is the euro, then all of these are at the same level of weakness, the euro, the Swiss, and the yen. Then slightly stronger or less weaker would be the Aussie, would be the New Zealand, and would be the CAD. Less. And the less weakest of them all is the pound. So the pound is the strongest of the weak. Then the Aussie, the New Zealand, and the CAD, and then the three absolute losers or the absolute weakers are the Euro, the Swiss, and the Yen. But on the one side, it is only the dollar that is strong. If you want to see this in a very more profound way, look at Forex. These are the 8 ranges of the currencies indexes, and it's on Finviz. And as you can see, the only currency that is moving up is the dollar. The euro is crashing, the Swiss is crashing, the CAD is crashing, the yen is coming down also, but the trend is major. The Aussie is coming down, and look at the zero and the pound. The only one that's going up is the dollar. So if that's the case, we're not going to fight this. We're going to use this information to time ourselves into the trades. So we are going to, if we are going to plan our trades, we're going to be looking at buying the dollar yen. We're looking at buying the dollar Swiss. We're looking at shorting the euro dollar. We can also buy the dollar CAD. We can also short the Aussie dollar. And we can short also the the dollar New Zealand. I wouldn't be too much in favor of this one simply because of the interest rate difference, but you can still count it. But my first choice would be dollar yen, dollar Swiss, dollar CAD, euro dollar. In the pound, I can look at the pound yen, pound Swiss, euro pound, pound CAD, but I will be looking at the pound pairs when I get some indication from the chart that this thing is set. So for the short or the essence of this session, we're looking at the pound, the dollar yen, dollar Swiss, euro dollar, and the euro CAD. Also, there are a couple of exotic currencies that I want you to look at, and that would be the SEK, which is the Scandinavian krona, and the Norwegian krona versus the US dollar. And I'm going to show you, again, they're pretty much moving with the currency. They're extremely weak. And we've been talking about them in our planning session, weekly planning session, and you will see that. So we want to focus on the dollar, and we can take the dollar SEK also, and the dollar NOK. Okay, we are going to wait until next week when we do the planning session next week what we're going to do with the pound. But right now, we want to buy the dollar and short everything against the US dollar. Okay, so let's go and pick our pairs. If we start with the dollar yen, and I want to show you something. If you look at our long-term strategy, the software, if you look at the dollar, for example, SEK, excuse me. Look at the dollar SEK. This is the weekly base. Look at the dollar SEK. See how strong that move? Look at the dollar Danish. Look at the dollar Danish. You're going towards an all-time high. That's a weekly chart. That's the dollar Danish. That's the dollar SEK. Look at the dollar NOK. The dollar NOK moves very well. It's as if you're buying the ruble. The dollar NOK is as if you're buying the ruble because it's an oil-producing country, and it's moving with the ruble. Look at this. Look at the dollar NOK. These are good, solid trades. The one piece of advice that I will tell you is if you want to take the dollar NOK, the dollar SEK, and the dollar Danish, in addition to the dollar Swiss. No. The all-time highs are meant to be broken. Everything, resistance are meant to be taken, everything. If the question is, timing yourself into the trade, and this is what I was just trying to tell you, Andrew, is that you need to make your stop. First of all, take a small position. Take small position. Okay? And give it the right stop. Give it a wide stop. And when you take a small position, you are able to withstand the fluctuations of the market. So you time yourself into the trade. You're not going to go in tomorrow and jump and buy it. Look at this. This is the dollar SEK on Friday. It's humongous. But this is also, like what you said, it's a big range day. So I'm going to wait unless it takes out the high. But if it doesn't, then I'm looking for a pause, and then I'm going to buy it. So you're looking at the dollar SEK. You're looking at the dollar NOK. Look at this is fantastic. You have a high here, which is 7.9. You got 400 pips to go. This is a good time to get into the dollar NOK. That's a good time. It's far away from the high. Looking at the dollar Danish, look, I mean, this is just flew. But again, take a small size so you don't, the stop doesn't hurt you, the fluctuation doesn't hurt you, and let it ride. Because this one has a lot to go. Specifically, if the dollar NOK, look at this, the high here is, you got another 500 pips to the high. And if you look at the dollar NOK, because the close proximity, the dollar NOK, you got another 6,000 pips. So there are big moves left in the dollar NOK and the dollar SEK, and into the, look at the dollar Swiss. That's a major structural failure to the upside. You want to be buying of the dollar Swiss. So you need to be looking at. So to summarize what we're going to be looking at, so that you can, we are going to be buyers. These are the buyers. We're going to buy these dollar Swiss. We're going to buy dollar yen. We're going to buy dollar CAD, dollar Swiss. Going to buy dollar CAD. Going to buy dollar NOK, dollar SEK, dollar Danish, these are the ones we are going to be looking at buying. We are going to sell euro dollar, Aussie dollar, New Zealand dollar, and that's pretty much the general directions that we want to be focusing on, and we want to be doing, and you want to be waiting to get into the trade. I mean, this is, I mean, these are all the positions that, if you look at the stock market, when they sold off, I don't understand what you mean by the dollar sold off, Anis, but any pullback in the dollar is a buying opportunity. The key is don't look at something that is doing this, if you understand that the general trend is to the upside and you want to be buyer of the dollar, if you look at this intraday chart, if you are focused on the direction now that you want to be taking the direction, every one of those is a fantastic buying opportunity. You don't look at this as you want to short the dollar Swiss. You don't look at this as you want to short the dollar Swiss. You look at this as a place where you can buy the dollar Swiss. It gives you a support area. It gives you a level where it has stopped, and you can measure this, gauge it as your stop area, and you can take the move. The idea of looking at the market in a specific way will definitely impact the result of your return. Okay? And with that, guys, I hope you have gotten some information and that will help us in trading. And if anybody has any question, I'll be happy to answer it. If you have any quick question, you want to answer it. And if you want a copy of this PowerPoint, send an email to info, and I'll be happy to send it to you. So if anybody has any question or something, please feel free to ask. Okay, that's good. Okay, we'll have the recording for the room. If you want the recording for this session, we will try to upload it after that. What will be the SP for the Swiss? What do you mean SP? You mean structure point? The structure point for the Swiss, I mean, it already broke the structure point, Ernest. It broke it here, which is the 102. So, I mean, it should be testing the 99.71 right now. And if it breaks the 99.71, then it's the next place it will go is pretty much here. So it's sitting right now. It's about 5 pips below. I mean, 5 pips below that. There will be a structure failure to the downside. Okay? All right, guys. Happy New Year to all, and I wish you a very happy and a successful year. And we have some good news or stuff like that that we're coming up with for the new year. We will be sending you some information about it, and we wish you all the best. Okay? Have a great evening, everybody, and all the best. And we'll upload the recording if somebody wants to see. Best of luck, guys.